Let's jump right into this explainer and really unpack the complexities of the highly anticipated SkyeChip IPO. Look, right now there is just a tremendous amount of buzz surrounding Malaysia's semiconductor sector, and SkyeChip has positioned itself right at the very center of that conversation. But our goal today? We're going to move past the initial hype to see what's actually under the hood. We're strictly looking at the numbers, the business model, and the structural realities facing this company.
And honestly, it's pretty easy to see where all that hype is coming from. SkyeChip is hitting the main market with an absolutely massive 44.6% revenue compound annual growth rate from financial year 2023 to 2025. I mean, when you see top-line growth like that, it immediately establishes a hyper-growth narrative, right? They've literally gone from having just 4 customers to 18 in a very short window, perfectly riding this wave of global demand for high-performance silicon intellectual property.
But before we all get swept up in the AI semiconductor frenzy, we really have to ask a critical question about where all this demand is actually coming from. In today's highly interconnected, heavily regulated global tech landscape, explosive revenue growth is, well, it's really only half the story. The other half? Understanding the hidden vulnerabilities attached to that exact same revenue stream.
So, here's our roadmap for today as we systematically peel back the layers of this IPO. We're going to cover Meet SkyeChip, then the growth illusion, hidden financial red flags, geopolitical and execution risks, and finally, the final takeaway.
All right, Section 1, Meet SkyeChip. Let's unpack the business model.
Let's start with the basics of what SkyeChip actually does and, how they make their money in this booming space. They're what's called a fabless IC design house. That means they design the cutting-edge tech, but they don't own the massive multi-billion-dollar manufacturing factories. And they operate on a really fascinating dual-engine model. First, there's their silicon IP licensing segment. Think of this as their bread and butter. It makes up roughly 89% of their revenue as of October 2025. It is a fantastic model because it's asset-light. Once they design the intellectual property, they can license it out repeatedly at a really high margin. Contrasted against that is their custom ASIC design segment. This is bespoke, customized chip design. Now, while this scales fast, the billing is entirely based on project milestones, which makes the revenue incredibly volatile and lumpy. In fact, that segment dropped from over 55% of revenue in FY23 down to just 11.1%.
Now, what's genuinely encouraging right out of the gate is the quality of the management. You've got industry veterans leading the charge. We're talking alumni from heavyweights like Intel and Broadcom. But honestly, the most powerful signal here is that there is absolutely zero shareholder exit at IPO. The founders are not cashing out a single cent. Instead, they're retaining a combined 48% of the company post-IPO, and they've agreed to a minimum 12-month lockup period. That is a massive flex of confidence in their own future, and it ensures their interests are completely aligned with new investors.
Moving on to Section 2, the growth illusion, hype versus reality. Let's dig into the financials, because while that top-line growth is stunning, the underlying profitability tells a much more complicated story. Here's the catch. Despite booming revenue, gross margins have actually collapsed. They went from 59.1% down to 42.2% in just 2 years. The company attributes the squeeze to rising depreciation and really heavy capital expenditure investments in IP and mask sets, which are basically the ultra-expensive blueprints needed for chip manufacturing. So yes, they're making a lot more money overall, but it is costing them significantly more to generate every single new dollar of sales.
And that margin compression leads us straight into a major accounting reality that we absolutely have to address. Yes, they reported a super impressive 30.1% profit after tax margin for FY25, but it's artificially inflated. They actually paid an effective tax rate of just about 2.9% because of a very generous government tax exemption. The problem? That exemption has expired. Their new reality is Malaysia's statutory tax baseline of 24%. And as of the prospectus date, there is no confirmed replacement incentive, meaning they're suddenly fully exposed to a much harsher tax rate going forward.
So, the crucial takeaway here is that we simply cannot evaluate their profitability based on a tax break that doesn't exist anymore. When we normalize the math to reflect that actual 24% tax reality, their profit after tax drops significantly. We're talking a drop from a reported 35.9 million ringgit down to an estimated 28 million. The underlying profitability just isn't quite as bulletproof as the headline number suggests.
Next up, Section 3, hidden financial red flags beyond the surface numbers. Beyond the whole tax normalization issue, we really need to look closer at the balance sheet because it uncovers a couple of concerning structural realities.
Imagine this, 19 million ringgit in trade receivables were more than 120 days overdue as of October 2025. That accounts for a full 41% of their total receivables. For a company that only has 18 customers in total, having that much cash tied up in long overdue payments, well, it strongly signals concentrated customer payment stress, or possibly even contract disputes. It is a highly, highly concentrated risk.
Furthermore, because SkyeChip is transitioning away from purely licensing intellectual property and moving toward much more product-heavy ASIC designs, their capital expenditures are spiking. I mean, they burned through 36.8 million ringgit in capex in FY25 alone. What this means is that their free cash flow actually fell well below their stated profit after tax, practically hitting negative territory. Simply put, those impressive on-paper profits, they aren't translating directly into free cash flow in the bank right now.
All right, Section 4, Geopolitical and Execution Risks, the elephant in the room. Let's talk about the absolute biggest vulnerability for the company, one that is entirely outside of their direct control. This is the existential demand shock risk for SkyeChip. When you break down their geographic revenue, 73.3% comes from China and another 17.3% comes from Taiwan. So we're looking at over 90% of their revenue being highly concentrated in the China-Taiwan corridor. If Western governments decide to expand semiconductor export controls to cover silicon intellectual property licensing, SkyeChip's core revenue stream could be frozen practically overnight. They are walking a serious geopolitical tightrope.
Then, there's the matter of the IPO funds themselves. They're raising 352 million ringgit, which is largely earmarked for research and development. But as the prospectus actually points out, there's a massive circular dependency risk here. The money for their IC products R&D only gets deployed if they actually win new contracts first. This means the sheer act of raising cash doesn't mechanically guarantee growth. Investors are basically betting heavily on the management's ability to actually go out and win those contracts before that capital even goes to work.
And to deploy those R&D funds over the next 36 months, SkyeChip requires hiring 231 new technical staff. That is a monumental operational hurdle. Rapidly scaling highly specialized technical talent without degrading your company culture or the quality of your output is incredibly difficult. And here's the kicker. As of the latest practicable date in their filing, they had exactly 0 of these new recruits formally identified.
Finally, Section 5, the final takeaway, balancing the bull and bear case. Okay, let's bring all these threads together to weigh the undeniable strengths of SkyeChip against these stark structural vulnerabilities. The bull case here is, frankly, undeniably compelling. If AI memory IP demand continues to surge and they successfully leverage new platforms to break into the US and Japanese markets, the upside is substantial. But the bear case is equally stark. If US export controls freeze their massive Chinese business, or if that expired tax exemption isn't replaced, their margins and reported earnings will take a severe hit. The reality sits right in the middle. This is a business with a genuinely high-quality product, but it carries incredibly high execution risk and relies almost entirely on geopolitical stability in the China-Taiwan corridor.
While the AI narrative and the strong backing of cornerstone investors might create a short-term frenzy around the stock, the long-term reality is that this company must perfectly navigate a geopolitical minefield and somehow secure a new tax renewal to justify its fundamental growth story. So, as you digest this explainer, you really have to ask yourself, are you betting on a long-term semiconductor revolution, or are you just hoping the geopolitical music doesn't stop?